everybody, welcome to the Hodgin Law PC International Tax Lunch. We do this every month on the second Friday of the month, noon Pacific time. This month was an exception because of the tax deadline last week, so we're doing it a week later than usual, but typically it'll be on the second Friday of the month. You can listen in online, over the phone, or watch the show later on YouTube. And if you're in Pasadena or the surrounding area, you can come into our offices for the event and we'll buy you lunch. If you have a question during the presentation, please ask it in the box, and we'll be selecting a few of these questions for a Q&A session at the end of the tax lunch. So, to get started today, we're going to be talking about dual status tax returns. And this presentation is really designed to be a broad overview of how dual status returns work, how you know when you can use one, identifying some of the major issues that you would need to think about when you're preparing a dual status tax return. So we're not going to be going into a lot of in-depth detail in any one particular area, but if you have any questions about anything, feel free to ask, and we'll see if we can get those answered. So, a dual status tax return is used when you have two different residency statuses in 1 year, both a U.S. resident and a non-resident. Right here on slide 4, I have a little timeline. It starts with January 1st, 2002 and goes through December 31st, 2016. This just is a hypothetical situation where, let's say you have someone who comes to live in the U.S. somewhere in the middle of 2002, and they stay here for a bunch of years, and then they leave somewhere in the middle of 2016. So in between those times, let's say if they're spending all their time in the U.S., between entering the U.S. and leaving the U.S., they're going to be a U.S. tax resident for all that time in between entering and leaving. But in the year that they enter the United States, that's going to be a transition year, and the year that they're leaving the United States, that's going to be a transition year. And by transition year, I just mean for tax purposes, their residency status changes. In 2002, they become a U.S. resident. In 2016, they stop being a U.S. resident for tax purposes. So dual status returns are what happens when, say in 2002, someone in the middle of the year becomes a tax resident of the U.S. So what happens is they're flipping from non-resident to resident status, so they might be filing a dual status return for that year. Then in 2016, from the previous slide, when they're going from resident to non-resident status, again, they might be filing a dual status return in that year. It would just show the opposite type of transition. To understand how you make the determination of exactly what day someone switches over from non-resident to residency status or from resident to non-resident, it's necessary to have a good understanding of the residency tests that apply. So we're going to take a look at those for a few minutes. And the residency tests are basically a way of knowing, are you a resident alien or are you a non-resident alien for U.S. tax purposes? If the answer happens to be both in one single year, then you end up with a dual status tax year. The two residency tests that we're going to look at for our purposes today are the green card test and the substantial presence test. And there are, of course, ways to get out of these. In other words, things you can use to not count certain days towards substantial presence test. We're going to talk about a closer connection exception. We're going to talk about treaty elections. So you can kind of know how you actually apply these tests in practice. The green card test is fairly simple. This is met if you have a green card at any time during the year. And by green card, we just mean permanent resident status. And this one is fairly simple. You have a green card. You are a U.S. tax resident when you have a green card. And this is true unless it's abandoned or taken away. And by abandoned, what I actually mean is surrendered. Many people, in our experience, allow their green card to expire and think that because it expires that they are no longer subject to the U.S. tax system. That's actually not how it works. You actually have to take an affirmative action to surrender your green card before you cease to be a U.S. taxpayer. So if you let your green card expire, you continue to be a U.S. taxpayer until you turn in your green card with, I believe it's Form I-407, or there's also an option to just send in a letter with it stating your intent to abandon it. But until that has happened, you're technically still a U.S. taxpayer. So something to keep in mind. Now moving on to the substantial presence test. The substantial presence test is kind of more of a math equation, and this just relies on the number of days that you spend in the U.S. over a 3-year period. First of all, you have to be in the U.S. for 31 days in the current year. And then also, if that's true, you look at a 3-year period where in the current year you multiply your days in the U.S. by 1. In the prior year, you multiply your days in the U.S. by 1/3 or divide by 3. And then for 2 years ago, you take all the days you spent in the U.S. and you multiply them by 1/6 or divide by 6. You add those all together, and that gives you your results. And if you have at least 183 over that 3-year period and 31 days in the current year, then you've met the substantial presence test and you're a U.S. tax resident. Just looking at a very simple equation, for example, for this, let's say in 2014 you were in the U.S. 300 days. So you're going to end up dividing that by 50 because we're looking at 2014, 2015, and 2016. So 2014, you're going to take 300 days divided by 6. You get 50 that you use for substantial presence test. In 2015, you're in the United States 27 days, so you divide by 3, and that gives you 9 for substantial presence test. 2016, if you were in the U.S. 81 days, you're going to multiply that by 1, and that meets the 31 days in the current year requirement. So you add those all up, and you get 140 days. So in this example, the substantial presence test would not be met, and this person would not be a U.S. tax resident for 2016. Now, there's a couple terms that we should talk about when we're talking about the substantial presence test, and those are the meaning of the word days and the meaning of the word United States. And in ordinary language, we don't have to think too much about what these things mean, but of course, in the context of tax law, they have some pretty specific meanings. The United States, for the substantial presence test, means the 50 states plus the District of Columbia. It also includes territorial waters of the U.S., and probably most people won't need to worry about this last one, but the seabed and subsoil of submarine areas that are adjacent to U.S. territorial waters and over which the United States have exclusive rights under international law to explore and exploit natural resources. Most of you aren't going to need to worry about that third one, but it's one of the places. One thing to note is that it does not include other U.S. territories or U.S. airspace. So let's say you're in Guam, Puerto Rico, those places would not count as days that you count towards the substantial presence test. Or, for example, let's say you're in Canada and you're on a direct flight from Canada to Costa Rica and you're passing over the United States. You're just in the U.S. airspace if you don't stop in the U.S., that would not count as time spent in the U.S. And then let's take a look at what's meant by days. This is basically if you spend part of a day in the U.S., it is going to count as 1 day towards your substantial presence test. But there are some exceptions to this. So you're going to count all of your days in the U.S. except days that you spend commuting from Canada or Mexico to the U.S. to work in your job. You do not count days in the U.S. where you're here less than 24 hours and you're in transit between two places outside the United States. So in my previous example, let's say that you're in Canada, you're going to Costa Rica, and you have a stopover in Florida. And you spend 4 hours in Florida before continuing on to Costa Rica. Those 4 hours in Florida would not count as a day in the U.S. because you're moving between two foreign countries and you're there for less than 24 hours. Other days that do not count are days in the U.S. as a crew member of a foreign vessel, that you're unable to leave the United States because of a medical condition, and I didn't put this on the slide, but also that medical condition has to have arisen while you were in the United States. It can't be that, you got sick and then came to the United States after you got sick, and then you couldn't leave. The medical condition is supposed to have arisen while you were here for those days. And then lastly, days as an exempt individual. Exempt individual, of course, does have a specific meaning here, and it mainly has to do with what type of visa you're in the U.S. on. This includes foreign government-related individuals, people on A or G visas, but not A3 or G5. Teachers or trainees temporarily in the U.S. and complying with the visa requirements on A or Q visas. Students temporarily in the U.S. and complying with the visa requirements under F, J, M, or Q visas, and professional athletes who are in the U.S. for a charitable sports event. So those people, you would actually not include the days in the U.S. if you meet one of those situations, though like everything in tax, there are exceptions to everything, and I believe for the student and teacher trainee visas, I believe there's like a 5-year limit that you can use those. So everything we're talking about here is just the general rule. And if you meet one of these situations, definitely look more into the specifics because we're not really covering all of those little details here today. So I mentioned before that there might be ways out of the substantial presence test and the green card test. And one of those is by making a closer connection. Basically, this is something that you can use to override the substantial presence test if you meet certain criteria. To use this, you would have to be in the United States less than 183 days in the current year. Your tax home would need to be a foreign country, and you would need to have a closer connection to one or two foreign countries where you have a tax home. And I'll talk about in a second what closer connection actually means. But note that this one cannot be used if you have applied for permanent resident status or if you have a green card. So this one only works with the substantial presence test. The closer connection exception is essentially a facts and circumstances test, and it mainly has to do with where your stuff and your activities take place. So this looks at the location of your permanent home, your family, your personal belongings, your business activities, driver's license, voter registration, charitable organizations you're involved in, where you have a library card. It's sort of just where is your life primarily located. And if you can put enough of those criteria together so that it's weighted towards meeting the closer connection exception, then you would actually report that on Form 8840 and submit that with your non-resident return. And the effect of that would be basically as if you never met the substantial presence test for that year. And it wipes out your requirement to pay income tax as a resident. It also wipes out your information return requirements, so you wouldn't have to file the FBAR, the 8938, your 5471s, 8621s, all those information returns. If you're able to use the closer connection, those requirements you don't have to worry about anymore. You, of course, may still have to file returns as a non-resident if you have U.S. source income. The other thing I wanted to talk about is tax treaties. And these can be used whether you meet the green card test or the substantial presence test. Though you should keep in mind, if you have a green card and you use a tax treaty to claim that you're a resident of another country for tax purposes, that could potentially have some impact on your ability to renew the green card. So I'm not advising that you use this strategy, and if you're thinking about using it, you may want to talk to an immigration attorney just so you fully understand the impact of that. But this is an option for tax purposes to make you not a U.S. tax resident. To use this, you have to be a tax resident of a country that has a treaty with the United States. You can only use the treaty if that treaty exists with your residency country. And the treaty has to contain a tiebreaker rule for residency. And the treaties I've seen, there's usually a section where it sort of walks you through, here's how you can tell which contracting state you are a resident of. So you would use that and then file Form 8833 with your tax return, claiming those specific provisions of the treaty, and that would basically have the effect of you electing to be taxed as a resident of that other country. The effect of the treaty election is a little bit different than the closer connection. It applies to income tax only, so it would not wipe out your requirement to file the information returns. And also, this could be used for a full year or part of a year. You can have a treaty election to be taxed as a resident of another country as of some date in the middle of the year. And actually, if that happens, you would be in a situation where you're filing a dual status return. But we'll come back to that. And then one last thing I wanted to mention when we're talking about treaty elections is a situation where you might actually accidentally expatriate. So this could happen if there are green card holders who had their green card in 8 or more of the last 15 years, and they make a treaty election to be taxed as a resident of another country. Upon making that treaty election, if they've met the 8 or more out of the last 15 rule, they will be considered to have expatriated on the effective date of the treaty election. And depending on the circumstances of their situation, they may be subject to exit tax. But regardless, there's definitely more paperwork to file if that happens. Now, a lot of times, people can avoid this scenario by making treaty elections throughout the period they hold their green card to be taxed as residents of another country, because each time you do that, it counts as not one of the 8 years towards the 15-year count. But once you've hit the 8 years and then you make a treaty election, that would be considered an expatriation event. So just something, again, to be aware of. Again, I'm not advising that anyone do this or not do this, just things to consider if you're planning for one of these situations. So now that we've covered residency tests, we can talk about what it is that actually makes someone have a dual status tax year. And so, like I said before, if you look at the residency tests and you happen to be both a resident alien and a non-resident alien in the same year, then you would need to file a dual status tax return. So maybe the best way to kind of illustrate this is to look at a couple examples. So let's take Steve. Steve is a green card holder. He's been living outside the U.S. for 2 years, and he abandons his green card on May 5th, 2016, and of course he abandons it properly and files I-407 and turns in the green card, so he actually truly has surrendered it. The results of this situation are that from January 1st to May 4th, he would be a resident under the green card test, and then from May 5th to December 31st, he's a non-resident. So Steve in this situation could file a dual status tax return. Second example, let's say Jill enters the U.S. for the first time on February 1st, 2016, remains in the U.S. for the rest of the year, and so for the first month of the year in January, she was not a resident, but starting February 1st through December 31st, she was a resident for tax purposes. So that was just sort of a very general idea of how this works, but let's look at the specific rules that determine the residency start and end dates. There's a rule for the first year and a different rule for the last year. Under the first year rule, you meet the substantial presence test. If you meet the substantial presence test, then the first day of your tax residency is the first day that you're in the U.S. that year. If you meet the green card test, then it's the first day you're in the U.S. as a green card holder. If you happen to meet both tests, then you use the earlier of those 2 days as your first day of tax residence. Last year rule is actually very similar, it just kind of flips around some of the words. Substantial presence test, you use the last day you're in the U.S. If you meet the green card test, it's the first day you no longer have a green card. And if you meet both tests, then it's the later of those two. Now, in the last year, there's actually a statement that you would need to establish an earlier residency termination date than the default. Because the way it works is under the default rules, you would actually use December 31st as the end of your U.S. residency for that year. But if you submit a statement with your tax return, you can claim an earlier termination date. But to do that, you have to have a tax home in a foreign country and a closer connection to that foreign country. And closer connection in this context means exactly the same thing as when I was talking about it a few slides back. It's basically just, you know, where is your life situated? Where do you live? Where's your family? Where's your permanent home? Where's your business operations? All that kind of stuff. And the guidelines to making the statement, specifically what information must be provided in that statement, are found in IRS publication 519. And actually that's a really great publication for a lot of the concepts that we're talking about today. There's a lot of information about dual status returns to be found there. All right, now that we've talked about residency tests, how you can figure out what's your first day as a U.S. tax resident, what's your last day as a U.S. tax resident, now we can talk about what do you actually file when you have a dual status year. First of all, there's no joint tax returns. Dual status returns must be filed separately. And there's some basic terminology that we're going to be using. There's two different terms that you'll see in the sample tax return that you should have gotten with your materials and also on some of these slides. One is dual status return, and that's the subject of what we're talking about today, but it also specifically means the tax return that you're filing based on your residency status as of the last day of the tax year. So let's say that you are someone who's in a transition year where you're leaving the U.S., you've been a U.S. tax resident, and then you become a non-resident. Your dual status return will be the non-resident return because as of the last day of the tax year, you're a non-resident. And then the dual status statement is the information that you give to the IRS about the portion of the year where you had a different residency status. And the dual status statement can be provided in the form of a tax return, or it can also be in another format if you choose to do that. So in the example I was using, if someone is a resident and they transition out and become a non-resident, then what I would do as a tax preparer is I would use the Form 1040 as the dual status statement that gets attached to their Form 1040-NR, which is their dual status return. So let's say you have someone, an inbound person, they're coming into the United States, they're going to be a resident on the last day of the tax year, their dual status return is a 1040, dual status statement can be a 1040-NR or some other format, and what you end up filing is 1040, and you write the words dual status return across the top, and your dual status statement goes behind that. It can be a 1040-NR, and you would write the words dual status statement across the top of that. And then also at the top of the tax return where it shows the dates for calendar year, 2016 or other dates, you would actually fill in the other dates for the two portions of the year on the dual status return and the dual status statement. And so for an outbound situation, it's basically just the flip side of that. You're a non-resident on the last day of the tax year. Dual status return is 1040-NR. Dual status statement could be a 1040 or other format. And so on your 1040-NR, you're writing dual status return across the top of it. Your dual status statement, which most people would probably use a 1040, you would write dual status statement across the top of that. And so the dual status statement, just to talk about this a little bit more, as I mentioned, it is not required to be in tax return form, but it can be, and it's certainly convenient for those of us who prepare tax returns to simply continue to use those to report income because it's a format we're used to, and the IRS is certainly used to seeing that. So on both ends, it's usually just easier to provide the information that way. What we actually do, though, is a little bit in addition to that, we use the tax form 1040 or the 1040-NR to show the income from the dual status statement. And then we also include like an Excel spreadsheet sort of with a reconciliation showing the total income reported on the dual status return and then the portion of that income that's from the dual status statement period. And so here's how we tend to report the income. Let's say in an outbound example, last day of residency is June 30th, 2016. Say you had $50,000 of U.S. source income earned evenly through the year. We would put the $50,000 on the dual status return on the 1040-NR and then show that $25,000 of that was from the dual status statement period. And then here's a sample of an actual reconciliation page that we used for someone. My client was actually not named Steve Smith. I made that up. And this shows basically the type of information that we typically provide on a dual status statement. It just breaks down the tax form, line number, the category, a specific description of each source of income or loss, and then assigns it to one of these time periods that you see here across the top. And we've actually split it up into, in this case, this was someone who had expatriated. They had given up their green card, and so there was a pre-expatriation period, so that was the information that went on Form 1040. And then they had post-expatriation effectively connected income. This is when they were providing services while in the U.S. after they had turned in the green card. So that would be income that's sourced to the U.S. And then basically it's just sort of a breakdown of the whole situation, so the IRS can see everything that happened throughout the year and how you're reporting all the income. Now let's talk in a little bit more detail about how certain things will be reported on the tax return. And we're going to talk about income, exemptions, deductions, and credits, and all of this on a fairly high level. We're not going to go into a lot of detail with any one of these in particular. So, resident aliens are taxed on their worldwide income, and this is the same is true for U.S. citizens. This is basically the normal tax filing that you would see on your Form 1040, all your U.S. income, and then any income that you earn from other sources would be reported on your tax return. Non-resident aliens, people who do not meet substantial presence tests, do not meet green card tests, these people are taxed only on U.S. source income, and less common situation, but this could happen, foreign source income that is effectively connected with the U.S. trade or business. So non-resident aliens do not have to pay a U.S. tax on their worldwide income. And so when you're preparing the dual status return, you're splitting up two different time periods when you're operating under these two different principles for income reporting. For non-residents, there's a couple different types of U.S. source income. You could have income that's effectively connected with the U.S. trade or business, and you would often see that abbreviated as ECI, effectively connected income. This income is taxed at graduated rates, and the normal deductions are allowed, and so you would see this type of thing reported on page 1 of the Form 1040-NR. That's basically where all the effectively connected income is. Then there's also not effectively connected income, and this has a flat 30% tax rate on gross income, so there's no deductions, and that rate could potentially be reduced if a tax treaty applies, but in general, the rule is 30% tax rate. And this income is not reported on page 1 of the 1040-NR. It's reported on Schedule NEC for not effectively connected. So if you have someone who's a non-resident for a portion of the year, these are the places where you're going to be reporting the non-resident period income on the 1040-NR page 1 for effectively connected, and Schedule NEC for not effectively connected income. And the not effectively connected income, just to go into a little bit more about that, that's things like interest, dividends, royalties, stuff like that. It's not stuff like services or things you would think of as more active income typically. Now let's talk very briefly about exemptions. So resident aliens and U.S. citizens, they get the normal personal and dependent exemptions that we're all used to seeing on the Form 1040. And non-resident aliens are allowed only one personal exemption, and typically no dependents, but there are some exceptions to that. But for the most part, you would not see non-residents claiming dependent exemptions. Deductions. No standard deductions are allowed on a dual status return. So in the resident portion of the year, you are allowed to use, so typically residents are allowed to take a standard deduction, but if you're in a dual status year, for the resident portion of the year, you would have to claim itemized deductions only, and you can use the normal Schedule A that comes with Form 1040. Non-residents also can take some itemized deductions, and there's a sort of a special Schedule A. It's a little more limited than what comes with 1040 that you can file with the 1040 NR. And for non-residents, they have to have effectively connected income to use these deductions. Credits. Non-residents get, residents get the normal credits on Form 1040, and non-residents, they can take a foreign tax credit for foreign source income that's effectively connected, and some other credits available as well. We're really not going to go into much detail about credits. Actually, I think this is pretty much all we're going to say about credits today. But just to be aware of the general rules. And then the other thing I see fairly frequently, actually, on dual status returns is the foreign earned income exclusion. And the reason I happen to see this is because we work with a lot of expatriation cases, people who move outside the U.S., maybe they're U.S. citizens, maybe they have a green card, they live outside the U.S. for a while, and then they think, wait, why do I still have this? I'm not coming back. So they give up the citizenship or they give up the green card. So in the dual status year, in the transition year, they're actually living and working outside the U.S. while they're technically a tax resident. So these people are eligible for the foreign earned income exclusion. And you can, in fact, take that on a dual status return. So in general, this is available to U.S. citizens and resident aliens, and you can use it for the resident part of the year on a dual status year. For 2016, the amount that you're able to exclude is the first $101,300, and that amount changes every year because it's indexed for inflation. So how to qualify for this? There's two ways. One is under the physical presence test, and one is under the bona fide residence test. Physical presence test, you have to be outside the U.S. for 330 full days or more during a 12-month period, but that 12-month period does not necessarily have to be the calendar year that you're filing for. It just has to be a 12-month period that touches that calendar year. And then you prorate for the period that occurs during the tax year where you're filing the tax return. Under the bona fide residence test, which applies to U.S. citizens only, you basically have to have an intention to remain outside the U.S. indefinitely, and you can qualify based on facts and circumstances. And this really comes from your actual actions, less so what you say you intend to do. So if you have in fact been living outside the U.S. continuously for a number of years, that is what qualifies you for the bona fide residence test. And it would really be your actions that would have to demonstrate that. Just to give an example for the physical presence test, so you can see a little bit more detail about what I was talking about from the last slide. Let's say you have a U.S. citizen who lives and works abroad from June 1st, 2015 to May 15th, 2016. They meet the 330-day test because we're going to assume that they haven't been traveling back to the U.S. and they've actually continuously lived outside the U.S. for that period. So in 2016, from January 1st to May 15th, there's 134 days that they spend outside the U.S. So you just form a basic equation, 134 over 365. That gives you your ratio, and then you multiply that by the maximum exclusion, and you get $37,190 exclusion for 2016. For the 2015 portion of the period, it basically works the same way, but it has a different maximum exclusion amount. So that would be something that someone would be able to use on a status tax return. Now let's talk about the actual tax return preparation. So we're going to go through an example. Hopefully everybody attending today received there should have been an extra PDF that went out with the slides, and it's a sample tax return that we made up based on a hypothetical situation, and we'll walk through how to actually prepare the returns and what it's going to look like. So Mary enters the United States on May 1st, 2016, and stays for the remainder of the year. So Mary was not in the U.S. in 2014, not in the U.S. in 2015, and in 2016, that's actually 244 days. So she does meet the substantial presence test. We're going to assume she has not applied for permanent residence, isn't getting a green card, so we're just looking at substantial presence test. And if you recall from the first year rule for a substantial presence test, her residency start date is going to be the day that she enters the U.S. So her first day of U.S. tax residency is May 1st, 2016. So, looking at income and exemptions, she's going to be reporting her U.S. source income only for January 1st through April 30th. And then starting May 1st, when she becomes a U.S. tax resident, she will then need to report her worldwide income from May 1st through December 31st. Exemptions, she'll be able to claim personal and dependent exemptions because she's filing as a resident. Deductions, because she's filing a dual status return, she cannot claim a standard deduction, but she certainly can itemize her deductions. And all the normal credits that would be available for the resident portion of the year are available to her. And then for the non-resident portion, again, that's going to be a little bit more limited. I'm actually not going to have those on this sample return. So let's say that Mary had $100,000 in salary income, and then she had, of that $100,000, $30,000 of it was earned before moving to the U.S., and $70,000 was earned after May 1st when she moved to the U.S. And we're going to assume she had $25,000 of dividend income from foreign stocks. $10,000 of that was earned before moving to the U.S. and $15,000 after. And then $15,000 dividend income from U.S. stocks. $5,000 before moving to the U.S. and $10,000 after. So we're going to look at how this all plays out on the tax return. So the salary, the $70,000 earned after moving to the U.S. is going to go on the 1040, and this is because of the basic sourcing rule that says services income is sourced to where you perform the services. So before she moved to the U.S., she was performing the services outside the U.S., so it was not U.S. source income. After she moved to the U.S., she's performing the services in the U.S., and she's a tax resident for that period, so that, of course, is going to be reportable income on her 1040. Now for the dividends, the foreign source dividends, we had $15,000 after she moved to the U.S., $10,000 before. So the foreign source dividends before she moved to the U.S., those are not going to be taxable on her U.S. return because it's just foreign source income of a non-resident, so it doesn't really need to appear anywhere on her U.S. tax return. But the foreign source dividends after she became a U.S. tax resident and she's subject to worldwide taxation, that $15,000 does need to be reported on her 1040. And then for the U.S. source dividends, even though she's a non-resident the first part of the year, when she earns the $5,000 of U.S. source dividends as a non-resident. That $5,000 is U.S. source, so she still reports it on her U.S. tax return, but that would go on the 1040 NR portion of the return, and then the $10,000 U.S. source dividend income earned while living in the United States, that would go on her Form 1040. So let's take a look at the actual PDFs if you haven't already. So first of all, notice that the Form 1040, we've written dual status return across the top of it. That's on all of the pages of it. And where it says for the year January 1st to December 31st or other tax year beginning and ending, we have filled in May 1st as the starting date, December 31st as the end date. And you'll see down on line 7, the wage income of $70,000. The ordinary dividends, now that is comprised of the $15,000 of foreign source dividends that she earned while living in the U.S., plus the $10,000 of U.S. source dividends that she earned while living in the U.S. You'll notice that the $5,000 of dividends are not here. There's a reason for that. We'll take a look at that in a minute. But just moving on, you'll see on the second page, there are no standard deduction taken. And in this case, we didn't claim any itemized deductions, though in the real world, she certainly might have them. And then skipping down to line 62. In box 62C, the box is checked. It says 1040 NR Schedule NEC, $1,500. Let's go take a look at that. So going to the second to last page in the package, this is from the dual status statement part of the return, and this is the $5,000 of U.S. source dividends that she earned while living outside the United States. And this is because this is not effectively connected income, and so it would be reported on her Schedule NEC on her 1040 NR. So you're looking at, it's actually page 4 of the 1040 NR. It's line 1, dividends paid by U.S. corporations, and it's put in the 30% column because we're just going to assume the standard 30% rate. If, of course, she were living in a country with a different rate, we could apply a different tax rate to it. But you'll see down below at line 14, the 30% tax is calculated directly on that $5,000 of dividends. And then if you skip back 2 pages to the first page of the 1040 NR dual status statement, or actually, sorry, the second page of it, you'll see on line 54, the tax on income not effectively connected, the $1,500 flows directly to there. So this never even gets reported on the first page of the 1040 NR or the 1040. And then we've carried that $1,500 of tax through to the dual status return and put it on line 62 on page 2 of that. So that $1,500 of tax from the non-resident period just gets added into the 1040 that she's filing. And then, of course, because when the IRS opens up one of these returns, honestly, from my experience filing dual status returns, I don't think they're ever really expecting this, to be quite honest. I've gotten some strange notices, letters asking for explanations, letters randomly denying credits and things. Every time I've responded to them to substantiate what I'm doing and why, the item has been allowed. I've never had something actually be disallowed, but I think this comes from the fact that the IRS doesn't actually have a specific guideline or format for a dual status tax return. Like, they haven't published a specific form for this. They tell you, you know, go ahead and use a tax return as a dual status statement. They tell people who are processing returns how to process them, but they really give you a wide range, sort of a lot of leeway in terms of how you decide to report the information. So don't be terribly surprised if you get a letter in the mail saying, well, we decided to disallow your foreign earned income exclusion because you filed a 1040-NR, even though you wrote dual status statement across the top of it, even though you submitted the dual status statement with the Form 2555, even if it looks like you've explained everything, you still might get that letter, and then you might have to write back and say, hey, no, this is actually allowed, and here's why, and here's my calculation. And in my experience, they've always accepted that. So hopefully everyone else has the same luck. But just skipping to, I don't know exactly what page it is, in the PDF attachment, you'll see I actually put in the dual status statement reconciliation. And this is, like I said before, a standard thing that we use just to show what period the income is attributed to, where it's reported on what tax return, and then inevitably when the IRS sends us a letter because they're confused, this is actually a great piece of paper to be able to send back to them with your letter explaining what happened, so that they can see how you broke everything down. And in my experience, every time I send this to them for the second time with my letter, they end up accepting what I've submitted. So, unfortunately, dual status returns are kind of a weird little area of tax where I feel like the IRS tells you how to do it, and they know that it needs to be done, but it's not something you can e-file. My tax software certainly doesn't support it, so you're kind of putting it together to the best of your ability, using your judgment, and actually having a conversation with the IRS about it. Now, one thing that I did not mention in today's presentation, we're actually coming to the end here. There's one last thing that I wanted to talk very briefly about that I did not talk about anywhere in the slides, and that is information returns. And information returns, when you're looking at a dual status return, those are going to be something that you certainly have to think about. Because for the portion of the year that someone is a U.S. resident, all of the normal information return filing requirements exist. So for most people, this means an FBAR, reporting foreign bank accounts. For many people, this means Form 8938. And if you look specifically at the Form 8938 instructions, it tells you for the portion of the year that you're a U.S. resident to report your foreign bank accounts, foreign financial assets, everything you would normally report on the 8938. So for a dual status return, you should be aware more than on a regular return, because you've got people who are transitioning in and out of the United States, so it's very likely that they're going to have foreign assets that need to be reported in some way or another on their tax return. So these are the types of questions you would need to ask and find out about these things, and make sure that along with all the income reporting and everything, that all the information reporting is done as well. And that also could include things like 5471s for foreign corporations, 8621s for mutual funds, or other types of investments that would meet those requirements. Foreign trust reporting potentially on 3520 and 3520A, and a whole range of other information returns that would potentially apply. So just kind of wanted to touch on that a little bit, just so everybody's aware those are still things you would need to be thinking about. Now, that pretty much brings us to the end of the presentation. And so just to kind of summarize the things we talked about today, we started with a sort of general description of what are dual status returns. We talked about the residency tests that you need to understand in order to figure out what is someone's residency start or end date. We talked about specifically what forms need to be filed as part of the dual status return. We talked in very general terms about how income, exemptions, deductions, and credits work. We talked about how the foreign earned income exclusion would work on a dual status return and who would be able to use it. And then we looked at a sample tax return. So everybody, just keep in mind this presentation is not intended as legal or tax advice, and you should not use it to avoid penalties. So if you need help, please hire someone for that purpose. And if you would like to contact me, all of our information is here on the last page. Feel free to reach out to me. Email address is listed on the website, and there's a phone number there where you can give us a call as well. I think we might have time for a couple questions.
Yes, we do, and thank you, Deborah. Yes, we'll just take a few questions. And if you wouldn't mind just reading the questions out loud, just for those who are unable to see the questions, that'd be great.
Sure, not a problem.
Thank you.
Yeah.
All right, so the first question, in the dual status scenario, is it necessary to attach 1040 NR if there was no U.S. source income received while a non-resident alien?
The answer to that is no, it is not necessary, though you should provide something that serves as the dual status statement. And that could be as simple as a piece of paper that you submit with the tax return that says dual status statement across the top of it, and then explains that there was no income during that period, so nothing to report. And that would fulfill that requirement.
While using the foreign earned income exclusion for a dual status return, do you have to prorate it for the resident status period?
That one, I believe the answer is yes. That's at least how I have always done it and how I've always seen other people do it. I'm not sure what the specific law or rule is to cite for the reasoning for doing that, but I am about 85 to 90% sure the answer is yes.
What if a married couple with one child is filing a dual status return? Can the taxpayer claim two exemptions, one for the spouse and one for the child?
So this one, I would want to look at the specific return that they're filing, because I think it depends on whether they are actually filing a non-resident return or a resident return, and which one is the dual status statement. So it's hard to say for sure, but in general, on the non-resident period, you would be only claiming one exemption, and then for resident period, so if the 1040 is the dual status return that you're filing, if that's the status on the last day of the tax year, I believe in that scenario you are able to take potentially the dependent exemption, but I'm not sure, because the spouse would be required typically to file a separate return. So that one's maybe something that whoever's asking that question, maybe we could talk about that one a little bit further by email if you want to shoot me an email.
And we have time for one more question.
Okay, one more.
Inbound dual status return form 1040, it's a married taxpayer who moved to California, and only one spouse has U.S. W-2 income. Does that need to be split separately between the spouses for filing dual status returns?
That's a great question that I do not know the answer to off the top of my head. I will be very honest, the community property rules always throw me off a little bit. I believe, and Hao Shen sitting next to me can tell me if I'm wrong, but I believe it depends on where they were coming from and the marital property that was accumulated then, and not so much coming into California. Haoshen's making faces, I'm not sure. Do you want to talk, Haoshen?
Actually,
okay, let's talk about that one further by email. Whoever asked that, if you want to send me an email, we can talk about that in more detail after.
Okay. If you're able to answer the Crystal Gates question pretty quickly, then we could squeeze that one in as well.
Okay, let's see. Crystal Gates. Oh, okay. I got it. All right. For the tax on the NEC income for the non-resident return statement, would the taxpayer be eligible to claim a reduced treaty rate and include Form 8833? Yeah, that should be fine, assuming that they're eligible to take the treaty, to use the treaty election for that, and they meet all the requirements otherwise. Yeah, on a dual status return, that is certainly permissible.
Okay. Well, I'd like to thank Deborah Rudd and everyone attending online. Certificates of completion will be available for download within 3 business days. Thank you all for joining, and I hope everyone has a terrific day.